Bits and Banks is a show about digital disruptors, the show where we get candid with C-suite on how digital transformation is changing the lives of members and customers, one bold idea at a time. Today, I have Shawn, the Chief Business Architect at Vantage Bank. From wrangling bank operations to pioneering digital solutions, Shawn brings this trademark energy, which we were sharing just prior to this call, to build out standout experiences for customers and teams with innovation as the main thread. Now, for every serious discussion that we're going to have, and we're going to have some fun time with conversational bots and stablecoin, we start light-footed. Our guest today can lead a business transformation at Vantage Bank, fix a fence on the ranch, chart a new hiking trail, all before lunch. If anyone living the work-life integration dream, it's Shawn Main.
I hope that's true.
And you are going to do some of this stuff over the weekend, so I'm not off by a lot here. Okay. All right. So we're going to break this up into two sections. The first section will be around stablecoin, and then the second section will be around agentic AI and its applications to bank, right? And both of these are kind of two high value, high innovation quotient initiatives that mid-market banks and credit unions are adopting, and also the large banks have made large forays in this in terms of infrastructure. So this is interesting times for these technologies and the value that they can bring to customers. All right, so let's start with stablecoins first. For the audience, I think a good baseline would be, could you just define what stablecoin is for the audience, and how does that differentiate against quote unquote the more controversial digital assets in the crypto world?
Yeah. Well, and Aditya, again, thanks for having me on your podcast, your show. There's definitely a big convergence in modern finance today around AI and stable coins, and really just modernizing our infrastructure. So stablecoins overall, the best way I like to think about them is that they're a digital cashier's check. So if a bank today is very used to that process of how we mint a check to send $1 million to from bank A to bank B. Yeah. We track that liability on our balance sheet, take it out of the customer's account, put it on the bank's kind of liability sheet for when that thing's going to be redeemed. Stablecoin basically operates the exact same way. The only difference is that we're minting the token on the blockchain, and we're using the blockchain to facilitate the transfer of that value to the end recipient. Whenever that recipient wants to ultimately cash that out and turn it from stablecoin back into that $1 million or $100 million or whatever it is, they get those funds back from the issuers. Whoever issued that token, could be USDC, Tether, Custodia, whoever. They're the ones that are ultimately liable for that stablecoin value. That's why they hold those one-to-one. So that's another key critical point, is that stablecoins are held one-to-one in cash reserves against effectively that token, which represents that liability on the issuer.
Correct. And that could be highly liquid cash in a large, systematically a GSIB, or it could be backed by treasuries. So essentially, there's a lot of guarantee that is sitting behind this. So we'll dig a little bit deeper into that. Now, high level stablecoin, from how this revolution or evolution is evolving, is there are two main areas, and you kind of alluded to the first one, which is a payment trail. So that's kind of one area. And the second area is potentially as another source of earning yield in a more like a commercial A++ paper kind of mindset. So it could be commercial A++ paper, it could be an equivalent of money market or CDs. That could be another source of interest income for a customer. But those are kind of the payment rails, global payment rails, and potentially an equivalent of CDs or money market. So I think those are the two pieces. And I would love to talk to you about that as kind of our next dig in. Cross-border payments is definitely one area that we are seeing a potential of stable coins. But before we jump there further in, I wanted to ask you a question When you think about cross-border transactions being done by small and medium enterprise or small and medium business, well, today we have the ACH rails and we have Swift payment networks. We have things that quote unquote work. So as you think about this from a customer, one of your customers' angle, let's say somebody running a $2 million, $3 million import export business near the border with Mexico, Latin America, what incentivizes them? How do you incentivize them, or what is their perception of value that I should use stablecoin rail versus using something like Swift or ACH, which I've used in the past a lot? So what is the value that they see in this? I would love to see your articulation of that.
Yeah, and then maybe I can step back just a little bit too.
Sure.
There's really two things that are at play today. So it's not just stable coins, but it is also tokenized deposits.
Yes.
And so what we're really talking about here is taking a lot of the learnings that we have seen in the DeFi world and figuring out how to translate that into the TradFi world and modernizing the infrastructure that we have today.
Yeah.
And the only way to do that is if we start to tokenize assets. So that could be anything from real world assets, money market funds, securities, et cetera, but also the deposits in your account and those digital cashier's checks / stablecoins, which, in our opinion, really do focus a lot more on those international use cases where like a tokenized deposit is going to have a lot more applicability in domestic use cases here in the United States.
Yeah.
So stablecoins do play a strong role in that cross-border payment. And the reason it does that is it gives us a way to finally transact without having intermediaries.
Yeah.
Tokenized deposits do this as well, but stablecoins really do this very effectively because we no longer have to jump through, 3 or 4 major banks that sit within these individual countries as those intermediary banks. We can now transact directly with someone directly in that country. We may be able to transact directly with a bank in that country, and we can use stablecoins to facilitate that process. So by removing all those intermediaries in the transaction flow and steps, what we're doing is reducing the complexity, increasing the speed and delivery of those funds, and then really ultimately reducing the fees that come from that, because every bank in the hub has to charge something. They're here to make money and they're facilitating a process, but it's not really as necessary anymore. And the reason that all of that existed in the past is because our infrastructure is really fragmented, it's broken, it's very legacy, and it's not really designed to function in a real-time state. Stablecoins and tokenized deposits will fix all this because that gives us kind of a new layer, a new financial layer for all of us to operate on. And once we're all on that layer, everything will be a lot more efficient, both globally and domestically.
Do you see hesitation of customers adopting stablecoin? I get your enthusiasm. I get mine. And I get the enthusiasm of the administration with the Genius Act. I get it. But for your average Joe or average Jane who's running a small and medium enterprise business, this is an exotic instrument. Is adoption a problem, or do you not see that?
It will be, but the adoption is a problem today because it's extremely technical and complex. So no business is going to want to deal with a wallet string address and if I send it to the wrong place, I'm going to lose all my money. And so banks' role has always been about building trust and building abstraction layers so that we can create a very simplified experience for the customer to use whatever rail exists. So whether it was Fedwire or ACH in the past, we've always been building the layers on top of those so that they don't need to understand how the money moves, but just what they want to do so that we can facilitate it and get it done. That's the same thing that's going to happen here. That's why crypto has struggled. But as banks start to step in and really modernize the infrastructure, that's our key thing, is to just make it simple and make it easy to use.
Let's dig deeper in that. So when you look at the Genius Act, which has been proposed, there were certain provisions regarding, from a banking ecosystem perspective, on who can issue stable coins or crypto coins, now called stable coins in this context, which added a lot of comfort and regulatory framework around it. Could you speak a little bit about that and why that has been why that's been literally the harbinger and why this is certainly catching steam in the marketplace?
Yeah. Well, so basically, DeFi world has created stablecoins to help facilitate transactions in and out of risky assets, Bitcoin, other crypto. And that was because the banking system was not designed, or you're really not even allowed to,
Correct.
for people to on and off ramp into fiat. And so they had to find a way. And so all these players existed out there. They were, using stablecoins to basically guarantee that funds were worth what they were worth. And now you have to have a framework that says, if I really want this to operate in the financial ecosystem that we have today,
Mm-hmm.
we've got to have rules, we've got to have audits, we've got to understand if it truly is backed one-to-one,
Yep.
that we have the right structure around that. And so the Genius Act really basically put all of that in place. Now, just to be clear, it may be law, but there's a large comment period. There's a lot of
Yes.
like guidance that has to roll out. That's going to take 12 to 18 months for that to happen. But in the interim, that is helping a lot of companies start to think through what are the legitimate things that we have to do to make sure that these companies, have the funds, have the capital, are able to
That's right.
actually support the redemption, because that's really the biggest concern. Is you're worried about counterparty risk. How does
Yes.
a individual user of a coin know who the heck is actually responsible to pay them?
Yes.
Should there be any insolvency or other problem?
Let's dig into that a little bit more. We think about deposits under 250K accounts. We have the FDIC insurance. We have a mechanism that if a bank failed on a Friday, they come in and they kind of ensure, that's at least the idea, that on Monday
Yeah.
morning you have access to your funds. We don't have an easy recourse right now in the stablecoin space, and that's still being built out, thought through as part of the comment period on the Genius Act, and probably there'll be some amendments around that introduction. Now, what is your take on that? I'm just curious, like from a regulatory framework perspective, the security of somebody having stablecoins and knowing that it is carrying the value, pegged to the dollar or treasuries, etc. What happens if
Yeah.
something fails? Is basically my question. Yeah.
Yeah, so the Act does define effectively that there is senior treatment for these liabilities that are on these stablecoin issuers' balance sheets. There's still a lack of clarity, as far as
Mm-hmm.
how much and how that pans out. I think the challenge you really have with private issued stablecoins is that it's still going to be hard for an individual to understand that counterparty risk,
Correct.
to really understand, are those funds actually available, and is there going to be the right treatment? Are they actually compliant? Because
Mm-hmm.
if they are not compliant, then some of those guarantees actually do go away, and so that's the thing you have to be a little bit concerned about. And frankly, that's the reason the banking system exists today. Is we have all the rules, regulations, guidance, the frameworks, the capital requirements, et cetera. That's all been there for that reason, to maintain that trust, maintain the singleness of money, make sure that your money is always at par and there's never like a depegging
Yep.
issue.
Yep.
With private issuers, there's always a chance of depegging. There's always a chance of not being at par, or them not having one-to-one reserves.
Correct.
Now, technically, the Genius Act forces them to be compliant. They will be regulated under the OCC or potentially their state regulator.
Mm-hmm.
But again, there's always going to be a little bit more risk, because you have to think of it as you've got the Fed, you've got the banking system that layers on top
And
of
the
that.
OCC too, right? I think that's everything's going to fall underneath that. Yeah. Perfect.
Yeah,
Okay.
and then
Good.
you're laying on private entities on top of that. So it's just layers of how close can you get to par and less counterparty risk.
That is the critical piece, less counterparty risk. Two more questions on stablecoin, then we'll switch over to conversational bots. First one of the last two, there is some fear in community banks and ICBAs that have been representing this at the Congress quite a bit recently, is as customers adopt stablecoin, is there going to be a migration of deposits out of institutions, which in some sense it will then hinder your core business of lending to small businesses? So do you see any deposit flight risk here with stablecoins coming in?
It's frankly already happened. There's 289 billion of stablecoins already in float. The stablecoin issuers that have those dollars today, they get to choose where those deposits actually sit.
Yeah.
Yeah.
How do you see the regulatory landscape for kind of what is Genius Act plus plus? Where does this go looking forward? And I want to preface that question with one more point, which is eventually stablecoin will become essentially like a utility. It's like I get power in my house, right? And I don't get super excited about getting power in the house. What I get excited is I can talk to you and everything is working and I don't have an internet outage. That's a private joke when you and I just prior to this call. Now, the question is if stablecoin is really a rail that will become a utility, just like Swift or ACH and so on and so forth now. Then the question is the applications that are being built on stablecoin network are going to or on that infrastructure are going to play a big role in adoption and creativity of developers coming, let's say, on Stripe's network, right? Stripe just acquired Bridge and you're going to see a plethora of applications that run on the stablecoin rail. So two questions: how do you see that evolving, and how do you see the regulatory framework related to applications evolving? Any thoughts on that?
Yeah, I mean, I think leveraging the permissionless blockchain is critical to keeping innovation alive and making sure that fintechs and other providers that want to innovate on the blockchain and leverage stablecoins. I think that it's super important that we keep that. That is what makes our U.S. financial system so special. And stablecoins will help facilitate that. Stablecoins and the Genius Act are effectively allowing these tokens to act more like cash while still being on a digital rail that people can use. So I think that's really important. You know that those stablecoins are good. They're one-to-one backed, and then you can open up an ecosystem, effectively like open source technology has done, for the broader technology landscape. It's doing the same thing here for money, and that's enabling companies to do more with the actual underlying monetary asset.
So one example that was given, and I'm not an expert in this, but I read this as one potential application could be kind of advanced treasury management capabilities was one example was given. Another one was escrow, where today setting up escrows are complicated, but with this you could have applications that enable with a few clicks to set up an escrow to establish trust between two parties and so on and so forth. So but I think this is an evolving area, and maybe that is a real big wave that's going to happen once everybody's excitement about Circle and Stripe dies down about the utility, and they just treat it as a utility and think about the application sitting on top of the utility.
Yeah, I think that's a key point that you're hitting on that will obviously lead into the AI piece of this is we're now adding programmability to money, and we're doing it at the monetary layer, at the protocol layer. So we're not having to bolt things on that are external to money. They're now going to be part of the monetary layer itself, and that is really important because that is the only way that agentic payments and AI will actually ever be able to facilitate transitions between assets, transitions between other companies, et cetera. So it's critical that we get this infrastructure in place first. Then all those other things that we're dreaming about, agentic payments and AI, helping us kind of really manage our life and ecosystem. These rails have to be in place to support that.
Switch over to agentic AI. Good segue. Thanks for nudging me on that direction. There's this whole thing would have been stablecoin for too long. You have, in our past conversation, you have alluded that you're doing a lot of automation using agentic AI with focus around efficiency, reduction of error rates, and broadly speeding up the processes. And so just give us some sense of the types of use cases of agentic AI that you are thinking, planning, or currently under execution at Vantage.
Sure. Yeah, we are experimenting a ton with AI and agentic AI. The kind of first use cases that we went with out the gate were pretty basic. It was either build a knowledge bot that has access to our policy so that our employees can ask questions of policy instead of having to search and click and go hunt through documents. So that was an easy win, and that's a pretty easy use case for most to use. We then started to say, okay, how can we take these agents and then go and operationalize them for something like loan stress testing, as an example. So loan stress testing, most banks do it. They go pull, half their portfolio or maybe their whole portfolio. They look at their loans and they say, are we certain that the fields and everything we've put in this loan matches exactly what we are doing on the core and with the system and with our customers? So we're forced to validate that because things can get out of sync. It's not always, but they can. And agents can go and pull that information out of the document, give us an automated way to validate that against our core information and make sure everything is in sync. Every bank faces this challenge, and so that was a good one for us. There's a lot of examples of where we're using that type of technology, where we're just pulling out information instead of the human going in and manually reviewing and looking for these key elements. We pull it out, we make it more accessible, and we can do that in mass. So that's kind of the bigger difference, is we can actually do these things in bulk now. Things that just take humans a long time to go click, point, look, pull out, and we can automate that with an AI agent.
Let's look at the control side for what you just said. Take that use case itself. So how much of probes do you put in to make sure that when the agent is looking at contract documents or origination documents or setup documents and comparing that to what's going into the kind of the financial model for stress testing, that match was correctly done? The guardrails that you have to put in, because end of the day, irrespective of the use cases in agentic AI, it's going to come to the point of, do I trust this agent to do this without human intervention? Its ability to do it is we figured that one out. It works. But is it doing it accurately, with reliably, is very critical. What is your take on that?
Yeah. So two things, and I do think this is actually a pitfall for a lot of companies, is they expect AI agents to perform perfectly and to be 100% right all the time. But the irony behind it is that we don't expect our humans to perform perfectly and be 100% correct all the time. So, I think it's going to be, you have to look at your use case. You have to decide whether or not it is truly a high-risk use case that requires a much higher fidelity as far as accuracy goes, or is it a lower-risk use case and fidelity really isn't what you're looking for. For example, if I'm just trying to reduce the number of documents that my QA team is looking at in the back office, I probably only care about that I get 70, 80% of them just 100% straight through. The agent's done a good enough job, and we feel confident enough that it's classified the document and done the right thing. The other 20% kicks it out to the user. Maybe it's wrong, and we have to review it manually. That's okay, because now we've reduced 80% of the workload of our team, and they're not having to do those checks. So that's an example where it could be low fidelity, and we're not really worried about it. High fidelity, obviously, as you starting to get into, consumer credit decisions and things like that, you have a really good fidelity because it's a high-risk model. So those are the things that I think banks are going to have to look at, and you're just going to have to find that sliding scale within your own risk framework that says, this is what's okay, this is what's not okay. And even when it's high risk, that we know we're going to have exceptions, and then that's where you really put in that human the loop review and have to monitor and manage that.
And this is an area that Corridor, actually, with our GenGuardX product that you and I have been speaking about briefly, gives you the ability to kind of have those guardrails in a defined setup, build, evaluate, refine, and then conform and kind of get approval in a controlled, secure environment, with all of the rails put in, the data being authorized, the process being standardized, and the whole automation and regression tests whenever you make changes to this thing. So that is an area that Corridor is investing in, and you and I have been speaking about that. Last question on this agentic AI front. As we start to move to cases, the high grade cases where underwriting, you gave that as an example, or if there's a customer management issue that you're handling where either directly the LLM is interacting with the customer or through an agent assist form, where again the bar will be high. As you think about the regulatory frameworks, at least in the US, the mindset has been, let the industry define it, right? That's let it evolve. There's been a deliberate move towards let innovation foster and regulation will follow through. What is your take on that? Or how do you see that play out? Yeah.
I mean, we, especially in the banking industry, we definitely need, our regulators to, keep up with guidance and make sure that they're providing banks with, kind of expectations.
Mm-hmm.
I do think innovation needs to have its own kind of path and ability to evolve because it's moving so fast nowadays. It's pretty impossible for guidance and regulations to keep up.
Correct.
But if there's at least a way to sandbox that, or not penalize banks when they are trying these new technologies out and learning, as long as they're doing it within the proper risk frameworks, they have the right mindset around that risk, they're trying to manage that risk. There's going to be bumps, and as long as I think the guidance helps support the fact that there will be bumps, but still while keeping bad actors out, or keeping the keeping it from going awry. I think that's the most important part, more than anything.
And I think the regulators, I feel, also watching, learning, and again, grades, how much of regulation do you put in depending on the grade of these use cases? So go light, go medium, go heavy. And I think the 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 practicing book of the regulators will evolve and refine based on where they see emerging risk. I think there's a learning, watching, observing, and learning phase right now that's going on. And that might happen for a couple of years, and then things will start to really kind of mature out, and rule books will start to get better crystallized from that perspective.
Yeah, and I think it's just important to note too that especially from any regulatory guidance or any laws or anything like that that are trying to follow along this, we've got to empathize with the fact that they have a certain process they've got to go through.
Yeah.
They're learning at the same pace that we're learning, and so we have to be just as good stewards with them as they are with us, and we have to help them kind of come along with us.
That collaboration is going to be very critical, which will benefit the society. So, in that sense, versus it being a confrontation or a natural tension, that's the word I was looking for, between the regulator and the bank. This is one where they collaborate together for the benefit of the society. Cool. On that positive note, thanks, Shawn. This has been a fantastic session, and look forward to publishing this. And thanks a lot. Appreciate it. Thank you.
All right.